Welcome to The Explainer. Today, we're unpacking a massive financial mystery. We're going to look at exactly how the hidden mechanics of the 2008 global financial crash were completely missed by the world's most prestigious economist, yet somehow accurately predicted by a single alternative economic model. We're going to decode this crash, piece by piece, using the very data the experts either ignored or, well, completely misunderstood. To really grasp the scale of this mystery, we have to travel back to the time right before the collapse. Consider what Ben Bernanke, a leading figure of the mainstream economic consensus at the time, was saying. They were celebrating what they called the Great Moderation. I mean, they literally believed they had conquered economic volatility. The establishment was riding this wave of extreme, almost euphoric confidence, assuring us that everything was stable, solid, strong. They had absolutely no idea a historically devastating crisis was literally right on their doorstep.
But while the establishment was out popping champagne, let's consider the reaction of economist Steve Keen when he looked at the exact same economy. Holy shit, we're in deep trouble. His internal reaction was radically different. While mainstream models were projecting continuous, stable growth, around 2.5% to 3%, the reality was about to hit negative 2.5%. Keen looked at the data and saw a catastrophic wall approaching fast.
So let's dive into this. How on earth did the world's top economists, armed with supercomputers and endless resources, completely miss the biggest financial crash of our generation? This isn't just a story of a few misplaced decimal points. It's a profound mystery of flawed mathematics, fundamental blind spots, and, honestly, a willful ignorance of how real-world capitalism actually functions. To solve this mystery, we have to start with the framework clash, specifically neoclassical economics versus the theories of Hyman Minsky. The core of the issue really comes down to the very questions these economists were asking in the first place. First, we have the mainstream neoclassical economists. Their foundational question is, can a market system reach equilibrium? And they build all their math assuming the answer is yes. But as Steve Keen points out, the real-world answer to that is almost always no. It's like trying to force a square peg into a round hole. Then we have Hyman Minsky. Instead of chasing this mathematical fantasy, Minsky looked at the actual historical record and asked, can a Great Depression happen again? He realized that to understand the economy, you need a model where a Great Depression is an actual possible outcome. The shocking truth here, mainstream neoclassical theory literally cannot generate a Great Depression outcome in its models. It's programmed to be completely blind to it. Which brings us to Minsky's most brilliant and perhaps most counterintuitive observation: stability breeds instability. The absolutely crucial point here is how Minsky viewed the system. He argued that capitalism is inherently flawed and prone to crises. But here's the twist. The fundamental instability of capitalism isn't a downward spiral, it's actually an upward tendency. A long period of stable economic success doesn't mean we've conquered risk. It means we are actively planting the seeds for a massive speculative boom. Let's walk through exactly how this happens in historical time. Step 1. Right after a crisis, both banks and borrowers are absolutely terrified. They only engage in highly conservative lending. Step 2. Because only the safest projects are getting funded and the economy is recovering, almost all of these projects succeed. Step 3. This success creates a false sense of security. Banks and firms revise their risk premiums downward. They start thinking, hey, we don't need such a big safety buffer anymore. And finally, step 4. The accepted ratio of debt to equity rises. People start borrowing way more to buy assets, which naturally revalues those assets upwards. So, survival and success literally breed dangerous overconfidence. As this cycle of overconfidence accelerates and asset prices just keep rising, we enter a dangerous new phase: the rise of Ponzi Finance. This brings us to a really critical definition. What exactly is a Ponzi investor? Well, it's someone who buys a rising asset using borrowed money, but the cash flow from that asset doesn't even cover the interest on the loan. They are bleeding money every single month. Their one and only hope for survival is to sell that asset later at an even higher price. It is pure speculation. Now, remember those mainstream neoclassical models we talked about? They have something called a transversality condition. That's really just a fancy way of saying they mathematically assume Ponzi investors do not exist. They explicitly rule out a massive, very real part of capitalism. And this brilliantly illustrates just how desperate and irrational Ponzi finance can get. Take the story of Australian property developer and Ponzi merchant Christopher Skase. He was constantly borrowing from a company managed by the Adler family. And the Adlers actually played a game with Skase. Every time he came in for a new loan to keep his sinking ship afloat, they'd alternate who met with him and hike the interest rate by 1%, just to see when he would finally say no. He never did. The final loan he accepted before going bankrupt carried an absolutely staggering 25% annual interest rate. 25%. He agreed because, well, if he didn't get the cash that exact day, he was completely out of business. The sheer fragility of this system is just mind-boggling. I mean, think about the timeline here. Skase was putting together a $3 billion takeover bid for the legendary MGM Studios. He looked like an absolute titan of industry. Yet, literally 1 week later, his entire empire evaporated into bankruptcy because he couldn't cover a single $12 million loan installment. To put that in perspective, if you're a Ponzi investor, you look rock solid right up until the very second you completely vanish. So what transforms individual bankruptcies like Skase's into a system-wide global meltdown? Let's break down how the bubble actually bursts. Steve Keen took Minsky's theory and added a crucial mathematical trigger to it, the shift in income distribution. See, during a massive boom, the cost of raw materials, especially energy, starts to skyrocket, and workers demand higher wages. This eats directly into capitalist profits. Suddenly, even responsible, non-Ponzi investors find themselves short on cash, and they're forced to sell off assets just to service the rising debts. This sudden flood of new sellers hits the market, and asset prices begin to collapse. And the moment prices stop rising, boom, the Ponzi investors are instantly trapped. They can't sell for a profit, they can't borrow more, and they literally all go bankrupt at once, completely pricking the euphoric expectations of the entire market. And you know what? The real-world data matched this model perfectly. From the 1930s to the 1970s, the workers' share of GDP was rising, but post-1970s, it began a downward trend, while at the exact same time, the private debt ratio began climbing exponentially. Steve Keen saw this exponential debt increase and knew it mathematically could not go on forever. When it stopped, a catastrophic, debt-induced recession was completely inevitable. But the story doesn't end with the crash itself. We have to look at the incredibly absurd aftermath, which leads us to the great data blunder. So right after the 2008 crash happened, the one they all said was impossible, remember? The mainstream neoclassical economists did a postmortem, and they completely rejected the idea that finance or private debt caused the crisis. Get this, one of the founding architects of their modern models proudly stated that bank credit actually rose at the end of 2008 to an all-time high. They were using this to try and prove that a lack of credit wasn't the issue at all. Now, what is truly absurd about this is what actually happened behind the scenes. That paper, reviewed by 20 top economists, including 2 Nobel Prize winners and multiple journal editors, contained a fatal and honestly embarrassing mathematical error. They looked at a data chart for private debt, but because the chart happened to be labeled with the word credit, which in economics specifically means the annual change in debt, they completely misread it. They literally mistook the massive mountain of total accumulated debt for the yearly credit flow. Talk about a massive blind spot. If you actually run the numbers on their mistake, it becomes hilariously tragic. If their claim was true, that credit, the annual change in debt, had been running at around 100% of GDP per year since 1978, then by the time they published their paper in 2010, the total debt would have been 43 million times the GDP. Think about that for a second. These experts were so desperate to dismiss the role of debt in the crash that they didn't even realize they were making numerically impossible claims. Which naturally forces us to look at our present reality. Are we still in the trap? This builds a deeply concerning picture for today. To truly recover from a debt-induced crisis, an economy absolutely has to shed that debt. Look at the Great Depression. The private debt burden was reduced by a massive 65%. The system actually flushed out the bad debt. But look at the aftermath of the 2008 global financial crisis. We only reduced the private debt burden by a measly 15%. We never truly cleared out the underlying rot that caused the explosion in the first place. So I leave you with this final thought to take away. We are operating in an economic system that structurally transforms success into dangerous debt-fueled speculation, and the data clearly shows we barely deleveraged after the last massive crash. If the underlying debt is still just sitting there and the mainstream models are still completely ignoring it, are we actually in a recovery? Or are we just quietly waiting for the next catastrophic Minsky moment to arrive?